Today, we are doing something pretty radical. We're not just analyzing economics, we're basically staging a theoretical demolition.
That's a strong way to put it, but yeah, it fits.
We're taking those fundamental models, the ones taught in literally every macroeconomics class,
Yeah.
the diagrams that have guided governments and central banks for decades.
Decades, yeah. All around the world.
And we're going to argue that they've fundamentally failed. Collapsed, even.
Collapse is the right word. Theoretically, empirically. And the consequences are, well, systemic. We're talking about a critique that really goes to the heart of things.
It's not just some academic squabble, then.
Oh, definitely not. This gets at the root cause of why some major economies, like Japan, have been stuck in stagnation for so long. It even forces us to completely rethink huge historical events, like the Great Depression.
Okay, so what's the mission for this deep dive?
The mission is to really dig into this collapse. We're zeroing in on the classic tool of Keynesian economics, the ISLM model.
Right, ISLM. Investment saving, liquidity preference, money supply.
Exactly. We want to show you, the listener, why this failure isn't just some weird, isolated case like Japan's lost decades. We think the breakdown is actually built into the theory's core assumptions. It's a general failure.
Okay, so before we tear it down, maybe we should quickly build it up. What does ISLM actually claim to do?
Right, good idea. So ISLM is, on the surface, quite elegant. It's a diagram, a tool, that tries to map out the short-run equilibrium for the entire economy.
Finding that sweet spot, right?
Yeah, it's looking for that one combination, that single point where two key things balance out: the interest rate and the level of national income, or GDP.
And it does that by balancing two massive markets simultaneously.
Precisely. You've got the IS curve, which stands for investment equals saving. That represents equilibrium in the market for goods and services. Basically, it means what people want to save plus taxes has to equal what firms want to invest plus what the government spends. Leakages equal injections.
Okay, goods market covered. What about LM?
LM is liquidity preference equals money supply. This one represents the money market. Equilibrium here means the total demand for money, for transactions, for holding, just in case, liquidity preference has to equal the total supply of money.
And the standard story is that the central bank controls that supply.
That's the crucial traditional assumption, yes. The central bank sets the money supply.
So you plot these two curves on a graph. IS slopes down, LM slopes up, usually. And where they cross, bang, that's your equilibrium interest rate and GDP.
That's the textbook picture. And yeah, this simple diagram became the bedrock. For 70 years, policymakers have been thinking in terms of shifting IS and LM to fight recessions or cool inflation.
It's got quite a history, doesn't it? It wasn't Keynes himself who drew this exact diagram.
No, that's right. It originated with Sir John Hicks back in 1937, just after Keynes published his big book, The General Theory. Hicks meant it as a way to sort of summarize and simplify Keynes' more complex arguments.
A pedagogical tool, almost.
Initially, yes. Then Alvin Hansen picked it up and refined it in the late 40s. That's why you sometimes hear it called the Hicks-Hansen synthesis.
And then it really took off.
It did, especially when people like Paul Samuelson embraced it. It became the core of what's called the neoclassical Keynesian synthesis. It kind of merged Keynes' focus on demand management with older neoclassical ideas about markets eventually clearing.
And that combination took over economics education.
Completely. Every undergrad learns it. Central bankers use it, or at least used to, as their main framework. It's going to be 100 years old in about a decade. It's basically an institution.
An institution built on simplification.
Yeah.
And you're saying that simplification is where the problems start.
Exactly. Its simplicity gave it power, but it also created this massive conceptual rigidity. It locked thinking into a particular box. Interestingly, even Hicks himself later expressed doubts about it, felt it missed too much nuance.
But it was too late. The textbook inertia was too strong.
Pretty much. And our goal today is to show that the flaws, especially around how it treats money, are so fundamental that the model just can't correctly diagnose major crises or prescribe policies that actually work in the real world anymore.
That's a huge claim. All right, let's get into part one. Let's see this model try to tackle the big one, the Great Depression.
Okay, so picture the graph again. Vertical axis is the interest rate, let's call it R. Horizontal axis is national income, or GDP, let's call it Y.
Right. Cost of money versus level of economic activity. Let's break down the curves again quickly. IS first.
Okay, the IS curve slopes downward. Why? Well, it represents the balance in the goods market, remember. Y dollars a C plus I plus GA. consumption, investment, government spending.
And investment I is the key link to interest rates here.
Exactly. Typically, we assume investment is inversely related to the interest rate. If rates are high, borrowing is expensive, so firms invest less. Less investment means lower aggregate demand, which means lower equilibrium income Y.
So high R, low Y, low R, high Y, hence downward sloping. Got it.
Makes sense, right?
Yeah. Now the LM curve, money market balance.
Right. LM is typically upward sloping in the standard model. It balances money supply and money demand. The traditional logic goes like this. As national income Y goes up, people and firms need to make more transactions.
So they need more money on hand.
Yes, the demand for money increases. Now, here's the crucial assumption. If the money supply is fixed by the central bank, then this increased demand for money will push up the price of money.
Which is the interest rate R.
Exactly. So higher income Y leads to a higher equilibrium interest rate R. That gives you the upward sloping LM curve.
Okay. IS down, LM up. Intersection is equilibrium. Now, apply this to the 1930s. We know GDP plummeted. The question is why? Which curve moved and how?
Well, there were two main competing stories trying to use this framework. The dominant one, the standard Keynesian explanation, focused squarely on the IS curve.
Keynes' own view, basically.
Essentially, yes. He argued the depression was caused by a catastrophic failure of what he called effective demand. Confidence just evaporated. People stopped consuming. Firms stopped investing. Animal spirits died.
And in the ISLM diagram, that translates to
a massive leftward shift of the RS curve. Imagine we start at a healthy point, say point B, with high GDP Y1. The collapse in demand shifts IS way over to the left, moving the economy to a point like A with much lower GDP Y0.
resulting in mass unemployment, deflation, the whole catastrophe.
Precisely. And for decades, that IS shift story has been the standard textbook explanation for the Great Depression. It's all about inadequate demand.
But you mentioned a competing view, one that got sidelined, the one focusing on money itself.
Yes, and this view has deep roots. It was really pioneered by the American economist Irving Fisher back in the mid-1930s in his work on debt deflation. Later, monetarists like Milton Friedman picked up this thread.
What was their argument?
They argued that the primary driver wasn't just a fall in demand, but a vicious contraction of debt money. Bank runs, failures, people defaulting on loans. This didn't just reduce wealth, it actually destroyed a huge chunk of the money supply itself.
Because in our system, bank deposits created by loans are a large part of the money supply.
Exactly. When loans go bad and banks fail, that money vanishes.
So in the static ISLM model, how would you show a shrinking money supply?
That would be represented by the LM curve shifting to the left. If the money supply contracts for any given level of income Y, the interest rate R needed to balance money supply and demand would have to be higher. So LM shifts left.
Okay, so maybe the economy moved from A to B in that case. A leftward LM shift causing GDP to fall from Y0 to Y1.
That was Fisher's and Friedman's core argument. They believed this contraction of credit and money was the real engine driving the downturn and the deflation.
So we have two clear hypotheses using the same diagram. IS shifts left, Keynes, or LM shifts left, Fisher-Friedman. Now here comes the critical part. Why did mainstream economics, the kind taught in textbooks like Mankey's, end up rejecting the LM shift, the money contraction story?
They had to reject it if they strictly adhered to the rules of the static IS-LM model. Professor Mankiw, in his popular textbook, lays out the reasoning based on the model's internal logic and the historical data. There were a couple of points, but the second one is the killer.
Let's hear the first one first, the less decisive one.
Okay, reason one was sort of quantitative. For the LM curve to shift left enough to cause the depression, the real money stock, that's the nominal amount of money adjusted for falling prices, should have declined significantly.
And did it?
Well, the data is messy, but standard measures showed that the real money stock between 1929 and 1931 actually rose slightly, or at least didn't fall dramatically. So that casts some doubt on the scale of the monetary contraction needed for the LM explanation.
Okay, a data challenge? But maybe definitions of money were tricky back then, or deflation was faster than nominal contraction. What's the more fundamental reason the LM shift was rejected?
It's the interest rate prediction. This is the theoretical linchpin. Look at the diagram again. If the LM curve shifts left due to money contraction and the IS curve stays put, where does the equilibrium interest rate have to go?
Well, the intersection point moves up along the IS curve. The interest rate has to rise, say from R0 to R1.
Exactly. It must rise. If money becomes scarcer relative to the demand for it, driven by income Y on the IS curve, the price of money, the interest rate has to go up. That's a non-negotiable theoretical outcome of a leftward LM shift in the static model.
So the standard ISLM model predicts if the depression was caused by money supply contraction, LM shift left, then nominal interest rates must have risen sharply in the early 1930s.
Precisely. And this is where the entire explanation collides head-on with historical reality.
Because interest rates didn't rise.
They did the exact opposite. Nominal interest rates declined dramatically during the Great Depression. Commercial paper rates, treasury yields, they all fell. Rates were around, say, 5.9% in 1929, but they plunged below 1% by 1935 and hovered near zero for years after.
Wait a second, that's not just a small discrepancy. That's a complete contradiction. The model predicts rising rates. The facts show falling rates.
That's the fatal blow for the static ISLM interpretation of the monetary hypothesis. Since a leftward LM shift must cause rates to rise in the model, and rates actually fell, mainstream Keynesian economics concluded that the money contraction hypothesis had to be wrong. It couldn't explain the facts as filtered through their accepted model.
So by elimination, they were forced back to the IS shift.
Yes. The only explanation left standing within the confines of the static ISLM diagram was the collapse of effective demand shifting the IS curve leftward. That could explain both falling GDP and falling interest rates, moving down along the LM curve. It's kind of mind-bending. The limitations of the diagram itself forced economists to discard a whole theory about money's role, simply because the diagram couldn't make the interest rate prediction match reality. The tool dictated the conclusion.
That's precisely the danger. A simplified model became treated as reality itself, and this misdiagnosis, forced by the rigid structure of static ISLM, naturally led to policy prescriptions that were, well, also flawed or incomplete. Which brings us neatly to part 2.
Right. Let's talk policy. If the diagnosis is insufficient effective demand that IS curve is shifted left, what's the standard Keynesian fix?
It's straightforward. Fiscal stimulus. The government needs to step in and spend money. Increase government spending financed by issuing bonds.
The idea being to push that IS curve back to the right towards full employment. This is the whole basis of countercyclical fiscal policy, right? When the private sector pulls back, the public sector steps up.
Absolutely, that's the core prescription. But
Yeah.
the traditional ISLM model immediately throws up a big warning sign about doing this. The famous crowding out effect. We hear this constantly in debates about government debt and deficits. How does the model predict this?
It comes directly from that core assumption we keep hitting, the exogenous fixed money supply. The LM curve doesn't move on its own.
So the government decides to spend more, shifting IS to the right.
Yes, but that spending has to be financed. The government issues bonds, trying to borrow money. Now, if the total pool of money or loanable funds in the economy is fixed, because LM is fixed, the government is suddenly competing with private firms and households for those limited funds.
Increased demand for a fixed supply of loans.
Means the price goes up, the price of borrowing is the interest rate.
Mm-hmm.
So as IS shifts right, the equilibrium point has to move up along that fixed LM curve. The interest rate rises, say, from R0 to R1.
And that rise in interest rates is the crowding out.
Exactly. Higher interest rates make it more expensive for private firms to borrow and invest, and maybe for consumers to borrow too. So the government spending crowds out some private spending. The stimulus effect is dampened.
And the mainstream warning follows from that. Don't overdo the deficit spending. It'll push up rates, harm private investment, and if you borrow too much, you risk bond markets freaking out, maybe even default. Hence the push for governments to maintain fiscal discipline, aim for a primary balance eventually.
That's the standard orthodoxy, yes. It's the advice that has often led to calls for austerity even during recessions. Keep the debt manageable, because crowding out is real.
Okay, but now we have the perfect real-world laboratory to test this prediction. Japan, over the last 30 years.
Exactly. Japan faced decades of stagnation following its bubble collapse around 1990. And what did the government do? Massive, sustained fiscal stimulus year after year. They accumulated government debt levels that are, relative to GDP, off the charts globally.
While simultaneously being lectured by many mainstream economists about the dangers of this debt and the need to restore that primary balance to avoid catastrophe.
Precisely. So according to the standard ISLM model and the crowding out theory, what should have happened to Japanese interest rates?
They should have gone through the roof. With that much government borrowing competing for funds, rates should have been sky high.
And what actually happened?
They stayed flat, rock bottom, near zero, basically, for decades.
That is the single most devastating empirical failure of the static ISLM framework. The crowding out effect, the core mechanism warning against large deficits in the model, simply did not happen in reality in Japan.
It completely breaks the model's prediction.
It proves definitively that the ISLM analysis based on a fixed money supply and the resulting crowding out theory were fundamentally wrong for a modern economy like Japan's. The supposed constraint just wasn't there.
Okay, so if fiscal policy alone runs into this theoretical but empirically absent crowding out problem, what's the other lever policymakers are told to pull?
Monetary policy, right?
Yes, that's the backup plan, or often the complementary plan. To avoid crowding out, the central bank should step in. How? By increasing the money supply.
Which, in the model, shifts the LM curve to the right. Exactly. So the government does fiscal stimulus, IS shifts right, and the central bank simultaneously does monetary stimulus, LM shifts right. The idea is you can get the economy back to full employment without interest rates rising. Maybe rates even fall, encouraging more private investment, fiscal and monetary coordination.
And Japan tried this too, didn't they? Especially with unconventional policies like quantitative easing, QE. That's literally pumping money into the system, shifting LM right.
They did massive QE programs. The Bank of Japan bought enormous amounts of government bonds and other assets, flooding the system with liquidity. This certainly pushed the LM curve right, and it did succeed in pushing interest rates down to zero and keeping them there.
But did it work? Did it revive the economy?
No, that's the other major failure. Despite zero interest rates and massive QE, private consumption and investment remained stubbornly stagnant. The economy was stuck.
It fell into the liquidity trap.
Precisely. The liquidity trap is that situation where interest rates are basically zero. At that point, injecting even more money into the system doesn't do much. People or banks just hoard the cash or use it to pay down debt rather than spending or lending it. Monetary policy loses its traction because you can't push nominal rates below zero or not much below.
So whether it was fiscal policy risking a crowding out that never came, or monetary policy trying to avoid it but ending up in a liquidity trap, the ISLM model just failed Japan. It couldn't explain what was happening, and its prescriptions didn't work.
It collapsed. Theoretically, its core assumption about fixed money was proven false by the lack of crowding out. Empirically, its policy recommendations failed to generate recovery.
Which forces us, then, to identify the root of the problem. What's the core flaw?
It all comes back to that one fundamental assumption, that the money stock is exogenously given, determined solely by the central bank, like pouring water into a bucket from the outside.
And the reality is different.
The reality, especially in modern financial systems, is that money is largely endogenous. It's created and destroyed within the economic system itself, primarily through the process of borrowing and lending.
Which leads us directly to part 3. We need to ditch the old plumbing and install a new system. We need to understand the endogenous money ISLM model.
Exactly. The paradigm shift starts by recognizing that money isn't some fixed quantity dictated from on high. It emerges from and disappears back into the economy's activities.
So the central bank sets the rules of the game, maybe reserve requirements or the base interest rate, but it's the commercial banks and the public, through their decisions to lend and borrow, that actually determine how much money exists.
That's the core idea. Commercial banks create money, essentially out of thin air, whenever they issue a new loan. That loan appears as a deposit in the borrower's account. New loan, new deposit, new money.
And when the loan is repaid,
the money is destroyed. It vanishes from the system.
So the money supply isn't static at all. It's constantly churning, expanding, and contracting based on economic activity.
Precisely. Therefore, the money stock, M, can't be treated as fixed. It must be a function of what's happening in the economy. At a basic level, it's linked to the volume of transactions, which in the ISLM context, we approximate with GDP. So M is a function of GDP, 1M equals M, text GDP.
Okay, but let's get more specific about the creation part. What drives the demand for new loans that create money? We said earlier, aggregate demand is consumption plus investment plus government spending. Where does the borrowing fit in?
Primarily with investment and government spending. For significant investment projects, businesses usually need to borrow funds first. That borrowing creates new money.
And government spending, especially deficit spending.
When the government spends more than it takes in via taxes, it issues bonds. It borrows. Now, how that borrowing translates into money supply is complex, involving the central bank and commercial banks buying those bonds. But the end result under current systems is that government deficit spending also leads to an expansion of the money supply.
So the very acts that drive aggregate demand, investment, and government deficit spending are simultaneously the acts that create new money through debt.
That is the absolute crucial linkage in the endogenous money view. The money stock M in the LM curve isn't just passively related to GDP, it's actively created by the components driving the IS curve, specifically investment and government debt. So a more accurate function is 1/MM, tax investment, government debt.
This changes everything for the diagram, doesn't it?
Mm.
If the things shifting IS, like I and G, are also determining M, which determines LM.
Then IS and LM are no longer independent curves that intersect passively. They are fundamentally interlocked. They have to move together.
How does that work?
Think about it. If there's an increase in the desire to invest or for the government to spend, shifting IS right, that desire is realized through borrowing. That borrowing simultaneously creates the money needed, which means the LM curve also shifts right, accommodating the increased activity.
And if investment collapses, like in a recession?
Firms stop borrowing, maybe even start repaying debt. That destroys money. So as IS shifts left due to falling investment, the money supply shrinks, shifting LM left in tandem.
Wow, okay, so the defining feature of the endogenous money ISLM model is this tandem shift. IS and LM are locked together by the debt money creation destruction process.
Exactly. The money supply isn't static. It's dynamic, elastic, responding directly to the demand for credit in the economy.
This feels much more intuitive for how modern finance actually works. The old model felt like, as you said, gold bars in a vault. This feels like credit lines, digital money flowing instantly when a loan agreement is signed.
It captures that reality. Money is created when loans are made, destroyed when loans are repaid. It's this simultaneous process that the old model completely missed, and it's the key to unlocking the puzzles of crises like Japan's stagnation and the Great Depression.
Okay, let's put this new tool to work. Back to Japan, part 4. Reanalyzing the lost 30 years with the endogenous tandem shifting ISLM.
Right. Let's look at that period, say, roughly 1995 to 2012, when things were really stuck despite huge policy efforts. We start after the initial bubble burst. The economy is already in a slump. Let's call this starting point A.
What was happening in the private sector?
Massive deleveraging. Businesses and households scarred by the bubble burst and falling asset prices were desperately trying to pay down their debts. The data shows something like 125 trillion yen reduction in private sector debts over this kind of period.
That's debt destruction on an epic scale, which means money supply destruction.
Huge money supply destruction, yes. This private deleveraging was the primary force dragging the economy down, causing perhaps a 61 trillion yen fall in GDP relative to where it might have been. In our new model, this is the underlying force trying to shift both IS and LM far to the left.
But the government fought back.
Vigorously, with massive fiscal stimulus. Over that same kind of time frame, the government ran huge deficits, leading to a cumulative increase in outstanding government debt of around 600 trillion yen.
600 trillion, and this spending did have some effect.
Yes, it acted as a counterforce. This deficit spending increased GDP by about 66 trillion yen, according to some analyses. So the government action was pushing the IS curve back to the right, trying to offset the private sector's contraction.
Okay, now connect this to the endogenous money framework. In the old model, that 600 trillion yen of government debt should have sent interest rates soaring due to crowding out, but rates stayed at zero. Why?
Because of the tandem shift. The government's aggressive fiscal policy pushed IS to the right. But simultaneously, the very act of incurring that 600 trillion yen in debt created a corresponding massive increase in the money supply. Banks bought the government bonds, reserves were credited, money was created.
So the LM curve shifted right along with the IS curve.
Exactly. The government borrowing essentially created its own financing. The money supply wasn't fixed. It expanded endogenously to accommodate the government's borrowing demand. There was no competition for a fixed pool of funds.
So instead of the economy moving from the recession point A up along a fixed LM curve to a point B with high interest rates,
the whole system shifted. Both IS and LM moved rightward together. The economy moved from the initial recession point A to a new equilibrium. Let's call it C.
And what did point C look like?
Point C was characterized by near zero interest rates, the liquidity trap, and a level of GDP, Y2, that was only slightly recovered. The 66 trillion yen boost from government spending basically just canceled out the 61 trillion yen drag from private deleveraging. The economy was running just to stand still, accumulating huge public debt in the process.
So the endogenous model perfectly explains why crowding out didn't happen. The money supply expanded with the debt. It also explains the liquidity trap. The combined shifts push the equilibrium to a point where rates hit the floor.
Precisely. The crowding out effect, the central warning of the old model, is completely nullified under endogenous money. And it reveals something profound about government finance in such a system. That the government isn't actually constrained by a traditional balanced budget requirement in the way mainstream economics insists. Debt finance stimulus doesn't automatically cause rising rates because the spending itself creates the monetary accommodation. The real constraint is elsewhere, perhaps, inflation or resource availability, but not typically rising interest rates caused by competition for funds.
This is a radical departure. Okay, this endogenous tandem shift mechanism clearly works for explaining Japan. Now for the ultimate test. Can it resolve the Great Depression puzzle? Can it explain falling GDP and falling interest rates, reconciling Keynes and Fisher? Let's move to part 5.
This is where the tandem shift really shines. Remember the problem. The old model couldn't accept money contraction, LM left, as the cause because it predicted rising rates, contradicting the historical fall in rates.
So how does the endogenous model handle it? Let's walk through the sequence, starting from point A in 1929 pre-crash.
Okay, step 1, the bubble bursts. Panic ensues. Banks start failing, loans go bad, credit freezes. This is Fisher's debt money contraction kicking in.
Money supply shrinks violently.
Yes. So the LM curve shifts sharply left from LM to LM. This immediately starts pulling GDP down from Y0 towards Y1. Now, momentarily, if we could freeze time right there, the interest rate would spike from R0 towards R1 at point B, just as the old model predicted. This is the initial liquidity crunch.
But the economy doesn't freeze. This is where the tandem part comes in.
Exactly. Step 2. The same financial crash and panic that contracts the money supply also utterly destroys confidence and effective demand. Investment plans are scrapped overnight. Consumption collapses as people fear for their jobs and savings. This is Keynes's mechanism.
So the IS curve also shifts sharply left.
Yes, and critically, it shifts in tandem with the LM curve, from IS to IS. The collapse in the desire to borrow and spend happens concurrently with the collapse in the ability of the system to supply credit.
Okay, so we have LM shifting left and IS shifting left simultaneously. Where does the economy end up?
It ends up at a new equilibrium, point C. GDP has fallen drastically, much further than either shift alone would cause, from Y1 down to Y2. But now, crucially, what happens to the interest rate?
Well, the LM shift wanted to push rates up, but the IS shift represents a collapse in the demand for funds.
Exactly. The collapse in investment and spending, the IS shift, means the demand for loans dries up even faster than the supply of money is contracting, the LM shift. Even though the total money stock is smaller, nobody wants to borrow it.
You end up with an excess supply of loanable funds, even amidst a monetary contraction.
Precisely. There's a glut of money relative to the collapsed demand for it.
Right.
And what happens when there's an excess supply of something, its price falls. The price of money is the interest rate. So the rate falls potentially drastically from that initial spike at BR1 down to a new low level at CR2.
Wow. So the combined tandem shift from A to C perfectly reproduces the key stylized facts of the Great Depression. A massive fall in GDP and a sharp fall in nominal interest rates.
It does. It shows how Keynes's deficient effective demand, IS shift, and Fisher's debt money contraction, LM shift, aren't opposing explanations. They are two sides of the same coin, intrinsically linked by the dynamics of a debt-based money system during a crisis. They happen together.
And the endogenous money IS-LM model provides the framework to see that linkage, whereas the static model forced economists to choose one and discard the other.
Exactly. And because the static model couldn't handle Fisher's falling rates prediction, his whole debt deflation theory, the idea of money contraction being central, was essentially purged from mainstream macroeconomics for generations. It became taboo.
So policymakers were flying blind, in a way, understanding demand management, IS, but completely misunderstanding the nature of money and debt, LMM, and how they interact.
That's a fair assessment. They were missing the systemic structural vulnerability inherent in the debt money system itself, its tendency to violently contract during crises. And that misunderstanding is why policies often fail to prevent or quickly resolve deep slumps. The root cause, this analysis suggests, is the instability of endogenous debt money.
This theoretical revision is powerful. It explains the past. But what about its usefulness going forward? You mentioned limitations. Let's get into part 6. The limits of even this improved model and the policy path it suggests.
Right. We have to be honest about what the endogenous ISLM model can and cannot do. even in this improved form, it's still fundamentally a static model. It compares equilibrium points before the shock, A, and after the shock, C.
It doesn't really show the path between A and C or how long it takes.
Exactly. It's comparative statics, not dynamics. And there's a bigger practical problem now. Because IS and LM are interlocked, predicting the exact final equilibrium point C becomes much harder.
Why is that?
In the old model, if you knew how much IS shifted and LM was fixed, you could trace the outcome. But now IS shifts, which causes LM to shift. But the exact sensitivity, how much LM shifts for a given IS shift, depends on complex factors in the banking system, confidence levels, etc. It makes forecasting the precise outcome, especially the final interest rate, very difficult within this simple framework.
So while it provides a much better explanation of past events, its predictive power for guiding specific policy interventions is limited.
It loses some of its predictive clarity precisely because it's more realistic about the linkage. Its main value becomes diagnostic, understanding the underlying mechanism, rather than being a precise forecasting tool.
Which implies we need different tools if we want to actively manage the economy based on these insights.
Absolutely. If we take the endogenous money view seriously, we need to move beyond simple static diagrams altogether. The source material argues for a shift towards dynamic modeling methods like accounting system dynamics, or ASD.
What's the advantage of something like ASD?
Dynamic models like ASD track the actual flows of funds between different sectors of the economy, households, firms, government, banks, over time. They ensure that all the accounting balances, stocks like debt, and flows like income and spending add up correctly at every point in time. They model the process of economic change, not just the start and end points.
So ISLM helps us see what's wrong with the system, but ASD or similar dynamic models are needed to simulate how different policies might actually fix it over time.
That's a good way to think about it. The diagnostic power of endogenous ISLM is huge, but for policy design and simulation, you need dynamics.
Okay, let's focus on the policy implications then. Based on this endogenous debt money understanding, what's the proposed way out for economies like Japan stuck in long-term debt-fueled stagnation? It can't just be more deficit spending, surely.
No, the analysis suggests that just piling up more government debt to counteract private deleveraging is incredibly inefficient and ultimately unsustainable. The proposed solution is far more radical. It involves a fundamental transformation of the monetary system itself.
This sounds like the public money initiative mentioned in the outline. What's the core idea?
The core idea is to break the exclusive link between money creation and debt creation. Step one is a transition from the current debt money system to what's called a public money system.
How would that work? What is public money?
In a public money system, the power to create new money would rest solely with a public institution, likely the central bank, acting on behalf of the state. Crucially, this new money could be created without a corresponding debt obligation. Think of it as equity in the national economy rather than a liability.
So the government could potentially create money directly to fund public services or initiatives without having to borrow it first by issuing bonds, sometimes called sovereign money, or more controversially, helicopter money.
The exact mechanism varies in proposals, but yes, that's the essence. Money creation is separated from private bank lending and government borrowing. This allows the monetary authority to manage the money supply directly based on the needs of the real economy, not just passively accommodating debt demand.
How does this help escape the trap Japan is in? What does it do to the ISLM framework, even if just conceptually?
Conceptually, it allows the authorities to cut off the endogenous link that forces LM to move with IS. They could, in theory, fix the LM curve wherever needed, say at LM, to maintain stable prices and full employment without being dragged around by private debt cycles or forced into massive public debt accumulation. It severs the mechanism that leads to zero rates and chronic debt dependency.
Okay, so step one is systemic transformation. Move to public money to regain control over the LM curve. What's step two? How should policy be conducted within that new system? It can't just be printing money for everything, right?
Absolutely not. The focus of policy needs a dramatic shift. Instead of using government debt primarily to fill the demand gap left by private deleveraging, which Japan did, the goal should be to use public money strategically to stimulate private demand, specifically private investment and, to some extent, consumption C.
Why the intense focus on private investment? We know government spending. Doing it also shifts IS right. What makes IS so special in this framework?
This brings us to what might be the most startling finding highlighted by this analysis: the massive efficiency gap between government debt finance spending and private investment in stimulating the economy.
You mentioned a ratio earlier.
Yes. The source material calculates, based on analyzing data like Japan's, that an increase in government debt contributes only about 1/5, 20% of the GDP increase compared to the same nominal amount channeled into the economy via private investment.
1/5. So a dollar of private investment is potentially 5 times more powerful at boosting GDP than a dollar of government spending financed by debt. That's
Yeah.
huge. Why? What makes private investment so much more potent?
There are a few key reasons. First, private investment, almost by definition, is aimed at increasing productive capacity. Firms invest in new machinery, better technology, R&D, worker training, things that make the economy capable of producing more goods and services efficiently in the future. It accumulates capital.
It raises potential GDP, not just current demand.
Exactly. Government spending financed by debt, while it does stimulate demand in the short term, shifting IS, often goes towards consumption transfers or public projects that might be necessary, but don't directly add to the economy's long-run productive potential. Think of the classic Keynesian example of digging holes and filling them up. It creates jobs now, but leaves no lasting economic capacity.
So private investment builds the engine, while some government spending is just fuel.
That's a reasonable analogy. Second, private investment tends to create sustainable jobs linked to that expanded capacity and market demand. And third, remember the debt aspect. Private investment is usually undertaken with the expectation of generating returns sufficient to repay the debt, leading to eventual money destruction, a potentially stabilizing cycle if well managed. Government debt used just to plug demand gaps often just rolls over indefinitely.
So the public money initiative isn't just about changing how money is created, but fundamentally changing what we prioritize using money for.
Precisely. The strategy becomes transform the system to public money, then use that system primarily to incentivize and enable productive private investment. Use public funds to catalyze the 5x multiplier rather than relying on the 1x multiplier of debt-financed government consumption.
This seems to directly contradict decades of focusing primarily on government spending as the main tool for fighting recessions.
It does. It suggests that while government spending has a role, its efficiency is vastly lower than fostering a healthy environment for private capital accumulation. The goal should be growth that increases employment and builds the capital stock for the future. The old paradigm, relying on debt accumulation, mainly just sustained stagnation at enormous public cost.
Okay, let's try to synthesize this whole deep dive. We started with the standard ISLM model, the workhorse of macroeconomics for 70 plus years.
Right, and we saw how its fundamental assumption that the money supply is fixed and controlled exogenously by the central bank led it to misdiagnose the Great Depression, forcing it to reject the role of money contraction because it couldn't explain falling interest rates.
Then we saw how this flawed model led to policy prescriptions like fiscal stimulus that came with warnings about crowding out warnings that spectacularly failed to materialize in Japan, proving the fixed money supply assumption wrong in the real world. Monetary policy fixes like QE also failed to revive the economy, landing it in a liquidity trap.
The collapse of the static model forced a paradigm shift towards endogenous money, recognizing that money is created and destroyed within the economy through debt. This led to the endogenous money ISLM model, where IS and LM are interlocked and shift in tandem.
And this new model could explain both Japan's stagnation without crowding out and the Great Depression's combination of falling GDP and falling interest rates. It unified the Keynesian demand view and the Fisher-Monetarist money view.
Exactly. It revealed the root cause of these crises isn't just a lack of demand, but the inherent instability of the debt money system itself, particularly its tendency to contract violently.
Looking ahead, the analysis shows that staying within the current debt money system forces governments into massive, inefficient debt accumulation just to fight stagnation, as Japan's experience demonstrates.
Which leads to the systemic threat. If we don't address this fundamental design flaw, economies risk accumulating ever more unproductive debt, postponing but ultimately guaranteeing a future systemic crisis, the next Great Depression, when those debt levels become politically or economically unsustainable.
Now, the proposed way out involves a radical shift. First, transforming the monetary system itself to public money, separating money creation from debt.
And second, using that new system to shift the policy focus away from inefficient debt-financed government spending towards aggressively promoting productive private investment, leveraging that potential 5x efficiency advantage.
He really forces a complete rethink. The models weren't just slightly off. They seem to have fundamentally misled policymakers about the nature of money, debt, and the most effective ways to achieve long-term prosperity.
It challenges decades of orthodoxy. And it leaves us with a really provocative final thought, circling back to that efficiency gap.
The 5-to-1 ratio.
Yeah. If we accept, even directionally, that promoting private investment is significantly more potent, maybe 5 times more effective in boosting long-run productive GDP than simply spending borrowed government money. What does that imply for how we should structure our economies and our public finances?
It's not just about balancing budgets anymore. It's about maximizing the impact of every dollar flowing through the system.
Exactly. So the thought experiment for you, the listener, is this. Imagine you could redesign your country's economic policy from the ground up, knowing about this efficiency gap. How drastically would you shift resources and incentives away from debt-fueled public consumption towards fostering private capital formation? How much faster could we escape stagnation if we focused on the 5x lever instead of the 1x lever?
That's a fundamental question about priorities, efficiency, and maybe even the future stability of our economic system. Definitely something to mull over.